As we get ready to kick off a new year, we want to discuss the ongoing battle between market intervention and serious long-term fundamental problems in the form of debt and demographics. From a short-term perspective, if the S&P 500 can break above 1285, subsequent market action between 1285 and 1340 should give us some good information relative to the outlook for the first half of 2012. In 2012, we expect similar market themes in terms of what will drive asset prices. In the second half of 2011, the market tended to oscillate from focusing on relatively negative long-term fundamentals in the form of high levels of government debt around the globe, slowing economic growth, and unfavorable demographics in terms of being able to support pretty lavish entitlement programs around the globe. That's one aspect of what the market would focus on, and this tended to be negative in the second half, and we think these fundamental drivers will continue to be negative in 2012. However, market intervention is when you'll see in 2011, when policymakers and central bankers intervened in the markets, is when things became a little bit more bullish. As we closed out 2011, we feel the market tended to be focusing on more of the positive aspects in terms of driving asset prices from market intervention. The Fed recently announced some swap lines, and the ECB extended 3-year loans. So what we're going to be looking for early in the year, maybe in the first 2 weeks of the year, if this trend of focusing on market intervention carries over into the first few trading days of the new year, it wouldn't be surprising to see the S&P 500 take out this high, which is at roughly 1285. How we act in this area up here between 1285 and let's say 1340-ish may determine how things go for the first quarter or the first 6 months of the year. From a bearish perspective, if you follow DeMark counts, one thing that you could be looking for is if we clear 1285 and get 3 to 5 successively higher closes, it's possible that that could be a form of trend exhaustion, and we could see a reversal in a bearish manner similar to the bullish reversal that we saw here in October. If we can remain in this area and break above these levels, then it's possible that the market will continue to focus on market intervention and money printing early in 2012. Based upon what we know from the close, how we closed out 2011, probably wouldn't want to make too many long-term commitments until we find out what happens in this box and what happens in the first 2 weeks of the year. It's possible with a seasonal bullish bias in the first week of a new trading year, and this bias of market intervention driving the markets, that we could get a head fake in the first week to 2 weeks of the year. So flexibility and an open mind and maybe just some patience would probably be in order unless something changes. Since late 2007, market intervention has become more and more important relative to fundamentals, and one way that we can illustrate that is to look at the European Central Bank's balance sheet. And the ECB, or the European Central Bank, is Europe's Fed. And it's really a government branch or entity entering what are supposed to be free and private markets. So this is the ECB's balance sheet from roughly 2000 to 2004. And as you can see, it oscillated in a fairly reasonable range and didn't impact the markets in an abnormal way, in a way that the markets weren't accustomed to. And you'll see from this point here, in the last few years, that really hasn't been the case. Beginning in 2004, you can see this curve here starts to get a little bit steeper, and then late in 2007, we get some volatility here. And when you get spikes and volatility, it tends to be a yellow flag in terms of potentially there being fundamental problems in the economy. See, late in 2007 here, the European Central Bank intervened into the economy and markets in a way really that it hadn't previously, and this marks a shift, and again is a yellow flag for fundamental changes and fundamental problems in the economy. In September of 2008, you can see why it's becoming harder and harder to manage money just based upon fundamentals. When you see a spike like this in terms of the ECB's intervention into markets, in terms of flooding the financial system with new money and buying assets in what's supposed to be a free and private market, they can change the game very, very quickly on you. As we move forward here, things backed off a little bit going into the beginning of 2010, but the ECB's balance sheet made a new high in 2010, which is another yellow flag that they feel that they need to do more and more to combat high levels of debt and deteriorating fundamentals. Things backed off a little bit here, and if you were making decisions in 2011, which is where we are here, things changed abruptly again late in 2011. Look at this huge spike that we saw in terms of the central banks and market intervention just changing the rules and changing the outlook for asset prices, especially in the short term. Another form of market intervention that occurred late in the year, the Federal Reserve and central banks around the globe announced the week after Thanksgiving some currency swap lines. The market has interpreted this in the short term as being bullish, but we should remember that see this spike that we saw here recently in these swap lines, it's analogous to this spike that occurred here when they opened up swap lines, opened up the spigots in September of 2008. And we want to remember, don't interpret this as being too bullish, because after this point in 2008, when the swap lines were becoming more and more relevant in the market, here was the S&P 500, September 18th, 2008, when these swap lines were announced. The S&P 500 was trading around 1,200. That did not mark the end of the fundamental problems. Stocks declined another 45%, with the S&P 500 hitting an intraday low of 666 in early March of 2009. Another bias that we need to be a little bit careful of, in 2009, we had declines. We had a big rally off of the November 21st lows, and we started off the new year. This is early 2009. The bias for the first few trading days of the year held, and stocks got off to a good start in 2009. But this part of this chart here is barely a blip on the radar as the negative fundamentals took over. So the lesson for us today is we have to be a little bit careful. If the markets tend to get off to a good start this year, it doesn't necessarily mean that that's where we're going to go in Q1 and Q2 of 2012. It's possible that these negative longer-term fundamental drivers will take us out of this yellow box and we'll go back to a bearish bias relatively early in 2012. Let's take a look back at 2011, and you can really see the battle that takes place between negative fundamentals and market intervention. In the spring of 2011 here, this is where Europe really became headline news. This is where Greece said they were going to miss some financial targets. And the fundamentals and the debt problems in the United States and the downgrade drove the S&P 500 all the way down to an intraday low of 1074 in early October. Policymakers in Europe saw that things were deteriorating here. We made a new low. We broke out of this trading range. And intraday on October 4th, we spiked down, and there was a story that broke. And the way we interpret these things is it's basically market manipulation. A European policymaker picks up the telephone and they call somebody at the Financial Times and they say, here's a quote, we need to get it out there. And the quote that they got was that officials are exploring ways to pump more capital into the European banks, or they were exploring ways to recapitalize the banks. And what happened is, after that came out, we got an intraday reversal. So you've got market intervention in terms of saying that the banks are going to be recapitalized. And the S&P 500 rallied 20% in 18 sessions, which is almost unprecedented after the comment was made that they were thinking of recapitalizing the banks in Europe. After that euphoria of the bank recapitalization wore off, the reality of the high debt burdens and negative fundamentals started to drive stocks down again in a negative manner. So if you were making decisions based upon fundamentals, it looked like things were going to go your way again here. And you'll notice the market closed near its low here, closed near its low the Friday after Thanksgiving. And for all intents and purposes, it looked like we were going to take out this low again here until on the Monday after Thanksgiving, the rumor on Wall Street was that some central bank intervention was coming during that week. And you'll notice nobody seemed very interested in stocks here. And then when stocks opened on Monday, there really was no new news, but there was a rumor of more market intervention coming. And later in the week, that's exactly what we got. On Wednesday after Thanksgiving, the Fed announced these swap lines in terms of coordination with other central bankers around the globe. So we flip-flopped again from the fundamentals driving the market here to market intervention driving things. The S&P rallied 89 points in 3 trading sessions here and really just flipped the playing field again. To give you an idea of how significant the swap lines are and how over the top the central banker's intervention has become, on December 28th, the Wall Street Journal had an opinion piece from Gerald Driscoll, who was a former vice president of the Federal Reserve Bank in Dallas. The title of the op-ed was "The Federal Reserve's Covert Bailout of Europe." So as we go through some of his comments and perspective on these swap lines, keep in mind this isn't somebody that hates the Fed that's telling us to stock up on canned goods and ammunition. This is a former vice president of one of the Federal Reserve banks. In the opinion piece, Mr. Driscoll said, America's central bank, the Federal Reserve, is engaged in a bailout of European banks. Surprisingly, its operation is largely unnoticed here. And the operation that he's referring to is the swap lines that were announced and hinted to the markets the Monday after Thanksgiving when the markets were plummeting, and then was formally announced on the following Wednesday after Thanksgiving. He goes on to discuss that the central banks are engaging what he calls a roundabout procedure. They're looking for fig leaves, which means they're looking for cover, and you can pause this if you want and read it. What are the swap lines basically, and how are they giving each other cover? This is a graphic that we took from the Federal Reserve Bank of Atlanta's site from September of 2008, explaining what swap lines are. So in the present day, the swap lines are identical. Just think of this Bank of England here as just being the ECB. So the ECB doesn't want to give the appearance that they've given up on being an inflation fighter, and they don't want to look like they're printing money or printing euros to finance private banks in Europe. The Federal Reserve took a lot of heat for these swap lines in 2008 in terms of how many dollars were pumped into European banks. So the way that this thing was announced, they're trying to make it look like this is just a simple currency swap line. But ultimately what's happening here is US dollars are going to the ECB, and that money is going to banks in Europe, and the ECB gives the Fed euros. But ultimately, these swap lines and the ECB is engaging in bank loans. They're ultimately another form of a bailout for what are supposed to be private banks. And I'm sure there's plenty of private businesses, dry cleaners, and hardworking people in Europe that would love to have a bailout like this. In the opinion piece in the Wall Street Journal, Driscoll sums up the situation as follows. No matter the legalistic interpretation, the Fed is, working through the ECB, bailing out European banks and indirectly spendthrift European governments. It is difficult to count the number of things wrong with this arrangement. You can find the piece on the internet and read the whole thing by just using Google to search for this title, but if you want to pause this, you can read a little bit more about what Driscoll had to say. Again, going back to our feeling that if the S&P 500 can't perform well for more than a short period of time in early 2012, that ultimately the fundamentals of too much debt is the big driver here will take over. We have a previous video that explains it in detail, but quickly we'll go over it. If your government debt plus the size of your banking system gets to a point where it's greater than 5 times your government revenue, you have a major problem. And Kyle Bass calculated this, his firm, Heyman Capital in Dallas. Over 5x is a problem. Look at some of these numbers here. They're all in problem territory, and a lot of people have forgotten about Greece. Greece could still be a driver of negative things in the first quarter of 2012. It's possible that they could still default or have a write-down that's greater than 50%. It's possible they could go with a write-down of 75%, which could cause a lot of problems. To see the detail on this, you can Google and find the video. If you Google backdoor bazooka and short takes, which is the name of our blog, you can find a post from Shavako Capital and a link to a video. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.